Welcome everyone to today's audit and assurance class. We will understand today what is assurance engagement. So, to understand that, you need to think about answers of couple of questions first and assess yourself whether you think the same way or not. So, my first question is, how many types of companies do we have? So we are just going to talk about the types of companies that we have. So the very first thing that comes in your mind when I ask you about type of companies is public listed companies. Secondly, you will think about private companies. On third number, one word comes in your mind, which is non-profit organization, or we also call them non-governmental organizations, or simply we call them NGOs. And on last, state-owned or public-owned companies. Okay, so keeping the four names or four types of companies in your mind, my next question would be, what do you think? What's the general difference between public listed company and private company? Or what's the difference between listed or private company, public or private company? So, yeah, you're thinking correctly. So, what happens is in private companies, in private companies, shares are not publicly traded. It means they're not listed on stock exchange market. Means you or I cannot buy their shares as the companies are not registered on stock exchange market. On the other hand, in public companies, shares are publicly traded. Means we can buy shares because they are listed on stock exchange market. Okay, so by the way, there are different names for listed companies. Can you think about different names of listed companies? So we're just going to list down different names of listed companies. Okay, so let me change the color for that. Just give me a second. different names for listed companies. So what comes in your mind? Can you think about those different names? Yeah, so let's start. So the very first word is itself that I have used means listed. We call them listed companies. Why? Why this name? Because shares are listed on stock exchange market, right? Then the second name that we use for them is quoted. Students, why this name? Because the price of shares is determined from supply or demand of shares, right? That's why we can also call them quoted shares. On number third, we can also call them floated. Okay, so why the name floated? Because shares can be bought by anyone, means the shares are floated in the market, right? So the next name that we can also call is public. And why this name, guys? Because public is allowed to trade the shares, means to buy and sell the shares. Very good. So you will see the topic of assurance engagement, to understand the word of assurance engagement is so easy in itself that you guys will understand it while doing questions and answer session. So let's see it. So far, we have established that general public is owner of listed companies. They own the company, right? So please think carefully and answer my next question. That's very important. So the question is, what do shareholders want from company? So please tell me, if I say the word shareholder, okay? So when I say the word shareholder, what comes in your mind? What do they want from company? So I'm talking about shareholders. I'm not writing full name. I'm using the short word. SHS means shareholders. So what do they want from company? Yeah, students, what do you think? Yes, please. Okay. So yes, you're saying it right. The first thing they want from company is dividends. And yes, very good. They want growth in price of shares, right? So price growth of shares. Yes, there is another word for this term as well. This is also known by another word, and that is called capital appreciation. So when I say the word capital appreciation, shareholders want capital appreciation. It means they want growth in price of shares, right? So, and one more guess. What do they want apart from these two? let me tell you, this is investment security. So yes, shareholders want dividends. Shareholders want growth in the price of shares that they have purchased, means they want capital appreciation. And last but not least is they want investment security. Let me give you an example. So suppose I have bought a share of $10. Now, what do I want? That if this share price is not going up, then at least it should not go down as well. For example, if this share price is not going up to be at $20, I don't want the price to go down at $9 as well, right? So shareholders want three things in total: dividend, capital appreciation, and investment security. Again, there is one word for these three. There is one word for these three. And that one word is very important, guys. Always remember from next onwards, when I say return maximization or wealth maximization. When I say return, shareholders want return maximization or wealth maximization. I mean, they want dividends, they want capital appreciation, they want investment security, right? So, with this, we can move forward to our next question, which is about directors. So, what do you think? Who are directors? And the question is, guys, now what do you think? Who are directors? You have heard this term many times. Director. Who are directors? Yeah, yes, you're correct. Directors are ones who run company, right? So have you ever thought why not shareholders run the company themselves? Okay, so after all, they are owner of the company. So why is that so? That directors run the company and not shareholders? Yes, you're right, because all of them are not finance professionals. Shareholders could be anyone. They could not be capable for that. They could not be capable for running the company. For example, shareholders may be maybe doctors, sorry, shareholders may be doctors, engineers, literate, or even illiterate. So that is why they hire directors to run company on behalf of themselves, on behalf of shareholders. Okay, so they hire the directors. So the next question is again, if you're telling me the directors one company, then what do directors get from the company? What do they want? So basically, my question is, what do they want from company? Yes, you're right. Directors want, so if we list down the things they want from the company, the first number is They want salaries. Yes, you're correct. They want short-term performance-based bonus. Yes, on number third, they want long-term bonus. One more guess? Yes, you're right. They want non-monetary benefits. Non-monetary benefits like they want car, gold-plated phones, etc., etc. Okay, so when I ask you what directors want from company, you list down all of these four things. Okay, so let me tell you, there's again one word for all of these four terms, and that word is called remuneration. So there is one word again, and that word is this word is called remuneration. So when I ask you what do directors want from company, you tell me directors want remuneration. It means you are telling me that they do want salaries, they want short-term performance-linked bonuses, long-term bonuses, and non-monetary benefits as well. Okay, so if I think about this, if I think about directors and shareholders, then I have come to a conclusion that directors are looking for maximum remuneration and shareholders are searching for maximum return maximization, return maximization or maximum wealth, right? So guys, if you think closely here, we got a math problem here. So what is that math problem? This is that if we make profit and loss statement, when we make profit and loss statement, we calculate here profit after tax, right? So in calculating profit after tax, what do we do mainly? We deduct expenses from income, right? So in those expenses, there's also one expense, company's expense called director remuneration. Okay, so what happens is if we increase directors remuneration, right, to satisfy directors need because they do want maximum remuneration. Okay, so what will happen, this profit after tax figure or PAT will go down. If profit after tax is decreasing, what does it mean? It means dividend is also decreasing, dividend is also going down. It does mean that shareholders will become sad, they would be unhappy. And if I, on the other hand, if I increase director's remuneration, sorry, if I decrease, I've done this case before. So now, if in order to making shareholders happy, if I decrease director's remuneration, what will happen? Profit after tax figure would go up. Dividends will also go up, and shareholders become happy, but directors would be unhappy, right? So what will happen, guys? It means that directors will try to manipulate the performance of company in order to retain their maximum remuneration. They will find a way in which shareholders be happy with the performance of the company, with the level of dividends they are getting, and they also get maximum wealth, maximum sorry, not maximum wealth, maximum remuneration, right? So uh okay, let's keep it clear. Let's do it clear more. One more thing, one more question. What do you think? How do directors report company's performance at the year end? Because they are running the company on behalf of shareholders, so they have to report to shareholders, right? So what do you think? How do they report? So directors basically report in form of annual report, in annual general meeting, right? So this is AGM. AGM called annual general meeting, right? So, directors report in the annual report in annual general meeting, right? So, what do you mean by annual report? Annual report means there would be 5 financial statements of the company. 5 financial statements of the company means there would be statement of financial position, statement of comprehensive income and profit and loss statement, statement of changes in equity, statement of cash flows, and notes to the accounts, right? And with that, there would be a director report in annual report register as well. Okay, so uh, keep in mind, directors have their own financial interest, vested interest in company. So now, when in AGM, directors hand over annual report to shareholders and tell that this is the performance of company. Tell me, should shareholders believe directors? Should they trust them? No. What do shareholders want now? They want an assurance, a kind of assurance on the report that directors have not lied in the reports about performance of company, because they will doubt, shareholders will doubt that the directors would have tried to manipulate the performance of company in order to protect their maximum remuneration, their own interest, and they would deceive the shareholders so both would be happy, and but the shareholders in actual wouldn't be getting maximum return, maximum wealth. So who will provide this assurance? Here in this equation, the word assurance falls. The word assurance comes for the very first time. Guys, do you understand now in the equation that what happens is this is public listed company or public company. I'm summarizing the whole thing. Directors report on the performance of the company. They run the company. On the other hand, owners are shareholders. Shareholders want maximum wealth. Directors want maximum remuneration. What happen is, if we try to satisfy directors' needs, then shareholder would become unhappy. And if we try to satisfy shareholders' needs, directors would become unhappy. And directors also report to shareholders, right? So their remuneration, their maximum remuneration basically have a major impact on profit after tax. Shareholders doubt that profit after tax is the figure is less. Why? Because directors are getting more remuneration. So that's why they need assurance. And from whom they need assurance? Again, shareholders will hire some agents. Shareholders will hire agents to get the assurance. Those agents are called assurance providers, because they are providing assurance to the shareholders on the report that if the directors are lying or not. Okay, so assurance providers, they will tell the shareholders that if the directors are working in the favor of shareholders' rights, in the favor of shareholders' interest, or are they working in the favor of their own interest of maximum remuneration, right? So they are called assurance providers. Okay, and these assurance providers are, you guys, means the future auditors. We call these assurance providers auditors. And the engagement in which shareholders hire assurance providers to get assurance on the report provided by directors, that engagement is called my very first topic, for which I have asked you a lot of questions, is assurance engagement. That engagement is known to be as assurance engagement. I hope, guys, you have understood now the term assurance engagement, that what is it in itself. Thank you so much, guys. We'll see you in the next session. Bye bye.